Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Jacksonville, Florida. Welcome to the show, Brett Swarts.
Victor, grateful to be here. Thanks so much for having me.
Well, great to have you here. You've been a repeat guest on the show. Last time was a couple of years ago, I think 2023, if I'm not mistaken. Lots changed in the tax code in particular. But maybe before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, I grew up in real estate in California and the Bay Area mostly, building houses with my parents. Fell in love with that. Fast forward, went to college, played some basketball and scholarship. Took an internship at Marcus & Millichap where I learned investment real estate brokerage within the multifamily space. 2008 crash hit. Friends, family, clients lost half of all their wealth. And we had to try to pivot, if you will, at that point onto a better strategy or alternative strategy than just the 1031 exchange. And now this is what we do. We build capital gains tax exit plans across the country for businesses, Bitcoin, real estate exits. 5 kids, married almost 17 years. Love jujitsu right now and playing basketball still, 42, and my knees are, calves are still holding up, but it's questionable every year that goes by. So that's kind of my world right now.
Love it. So one of the things that I know you've specialized in the past is, and I'm sure you continue to, is our trust vehicles as opposed to just pure 1031, whether it's the Delaware Statutory Trust or a deferred sales trust. There's a lot that's also changed in the tax code, in particular relating to estate taxes. And can you talk a little bit about how some of these vehicles can potentially play a role in estate planning?
Yes, define the challenge that's going on. 15 million single, 30 million married, which is better than what it used to be for the estate tax and or the death tax exemption. If you've seen the show Yellowstone, it's the entire premise. Kevin Costner has, we'll call it billions of dollars of land or hundreds of millions. And his daughter Beth is like, Dad, you got to sell the land. He's like, I'm never selling the land. It's in the family forever. And she's like, but Dad, if they kill you, they're going to take the land anyways because the death tax is going to kick in and we don't have the money to pay the 40%. That's where he pauses and says, Beth, I'm never selling the land. It's in the family forever. It's like, well, you're facing this big, massive taxable event that is happening that the stepped up basis has not solved for. And it's 40%, again, above 30 million married, 15 million single within 9 months of the sale. And so most people tend to try to solve it through massive, expensive life insurance, giving it as much as they can away to their children, but they run out of kids and they run out of time to give it away. And a charity, which is great, but most people aren't 100% charitable per se, right? And so there's a mix there. And so we like to bring in a strategy that involves an irrevocable trust, but none of those other 3 requirements. And so the biggest mistake people make is A, not knowing their options, B, not understanding the rules or thinking the stepped up basis is going to solve for it, or 3, just throwing their hands up because they go, I'm too old to get life insurance or it's too expensive. And I'll just leave that to the next generation. And well, they could actually sell today while they're still alive to a third-party buyer. I'll use an example of a $130 million sale, and let's say all 130 million is inside the taxable estate. Let's say it's an apartment complex in, San Francisco or New York. Upon that sale, we can move it forever outside the taxable estate. Now the asset's gone with the buyer, but the money's in the trust, and this trust is going to pay back the married couple over their lifetime, but their kids are going to be the beneficiaries. And the neat part, Victor, is if that 130 million grows to, let's say, 200 or 300 or 400 million or whatever it grows to, that's forever also outside the taxable estate. And so we would call this having a tax flow mindset, in particular, estate tax flow mindset, because otherwise the government's going to crush you with 40% death tax, which nobody is going to be very happy about that.
When we talk about trusts, let's talk about the different types of trusts so that we're clear on our terminology. There are revocable trusts, there are irrevocable trusts, there are testamentary trusts, which crystallize on death. Let's be clear what we're talking about here.
Correct. So the one I've been referring to is an irrevocable trust, right? One thing about it that's nice, it's asset protected. Number 2, it is irrevocable. It doesn't mean it couldn't be unwound while you're still alive and then you just pay your tax, right? But you would lose the benefits of the outside the taxable estate. Number 3, the particular irrevocable trust we use is only going to do, it's a single entity trust that only does business with the individual family, okay? And so not to be confused with a living trust, which is typically revocable, most of the time revocable, and that has to do with passing assets outside of probate. And then there's also Business Trust 2, which is our 1.0 version, which is a little bit different. But for this, and you can go back to the other episode to hear more about that. But for this particular episode, it's really focused on the estate tax. The difference here on the payout, it's different than a traditional promissory note. It's more like an annuity payment, although it doesn't necessarily mean annuity, Victor. It's just what it's going to pay you. It's going to pay a set amount. It's kind of just set in stone based upon your life expectancy and your spouse's life expectancy. And it's going to be partial interest, partial cap gains tax. And so there is still that piece of it where you're going to pay some tax, but there's a saying, and it's really important to understand, you can have it inside your taxable estate, or really it's a rule, or you can have a stepped up basis, but you can have it outside your taxable estate or a stepped up basis, but you can't have both. And so you really want to figure out what's that first 30 million that I don't mind getting the stepped up basis on, which is beautiful because it's exempt from that estate tax. And then what's above and beyond that I want to maybe do some extra planning. And the interesting part is when you do the math, it becomes pretty clear. But I like to say that neutral is negative, but not doing a plan or not doing anything or thinking that you could just remain neutral is actually going to be a negative outcome for you if you're above these amounts.
When you define a trust, you are defining beneficiaries, and the beneficiaries of the trust could be income beneficiaries. There could be capital beneficiaries. They could be separated. They could be there could be a capital encroachment clause. There could be thresholds. Can you share a little bit your thoughts on some of these separations of concepts that might be invoked in the trust?
Yeah, good question. So and by the way, there's, I think, probably 1,000 plus trusts. So this pretty nuanced. And our strategies, we focus on really just two parts of the tax code. And so as it pertains to the one I'm referring to now, the beneficiaries are typically the children, although it could also be something that is going towards, a more of a giving legacy play of some charities and such, but not forced or required there. And so in that scenario, typically the kids, or it could also be a niece or nephew. It could be a brother or sister. It doesn't necessarily have to be just an heir. It just couldn't be your spouse because they're going to be a part of basically think of it like a creditor during their lifetime. So that's the first thing. The second part of that would be, I'm not sure I fully understand the question, but the second part of that I think would just be the ability to have protections, knowing that it's not commingled in other trust accounts, and you still approve of all of the investments that are there. You can also partner with the trust to go do your own transactions and your own deals, kind of like a self-directed IRA. So it's not forever, just in this box of a trust where you're just completely passive. You can still be active. And in that sense, you could partner with your kids or partner, with other partners to build other projects, do other deals. And so that flexibility is really the value that most families really find, that we have great tax planning coupled with the entrepreneur ability to be flexible, and having time is not as a restraint that gives the real benefits of this particular trust, again, without any life insurance, charity, or gifting required.
Now, one of the things that I've always understood about irrevocable trusts is they don't shelter against tax. What you're talking about, though, is sheltering against a very specific threshold for estate taxes, but not the other tax liabilities that crystallize on death, correct?
Yeah. So it all depends. I think what state in which you reside, right? Your total net worth, kind of these things. And these laws are dynamic and can change. And so certain states don't recognize, they have additional estate tax, that death tax, right? So definitely check with your CPA and find this out. But for our strategy, you're going to look at basically the total, think of like a wealth tax, right? So your total net worth is the equation that we use, total net worth. And then the second part is how much is inside the taxable estate minus the exemptions, times by 40% is going to give you a rough number, but it could be more, it could be less based upon your specific state and different things like that. But that's the 40% is the big one there, but there certainly could be. And to your point, during the lifetime, they're paying some cap gains tax and they're paying some ordinary income tax. They're deferring a lot of the cap gains tax and they're deferring a lot of the income tax, but they're still paying it around their lifetime. But the remainder of whatever is left at the end, that's the beauty. And that typically passes estate tax free. And then also typically it'll pass capital gains tax free. So it kind of eliminates the need for the stepped up basis in that scenario for the unique way that it's structured. Whereas the traditional other version that we use is a 1.0. It's inside the taxable estate, and the kids can only step into the shoes because it's just a promissory note, but that gain is kind of locked until they receive it. They'll pay tax on it. This other one is a little bit different in that regard. So that's what I would say. And I, of course, would say, look at all your options, weigh the pros and cons, make a clear decision. Interesting part about this strategy, it's been done thousands of times, been over 30 no change audits, close to 30 years, and all never had a change or a finding in the audits. And so it's been, in my mind, proven. The 1031 world, some of them in the 1031 world would tell you it's still not, it's not proven. And that's okay. We just keep closing deals. We just did a $70 million deal in Northeast, a business sale, another $40 million in the West Coast for the business sale. So we're still closing very large transactions with very smart, sophisticated people, but still everything is dynamic. Is part of why these strategies you're hearing about take time to understand and get to know us and understand how it all works for you.
Love it. Well, Brett, if folks want to connect, if they want to learn more, what's the best way?
Yeah, so I think a couple of ways. You can check out our book we wrote called Building a Capital Gains Tax Exit Plan. You can find that on Amazon. You can also just go to our website if you have a live deal of from $1 million net proceeds, $1 million gain, by going to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com.
Love it. And to be clear, you guys are you guys CPAs or no?
So I'm a trustee, and so this tax attorney CPA is my business partner, the creator of the structure. And so he's the one who's doing all that legal work. And so our role is to help set up and maintain the compliance within the trust, kind of like a qualified intermediary, kind of like an IRA company. And so the ongoing management of the trust, building the team, forming fractional family offices or actual family offices. I'm kind of like an offensive coordinator, make sure everyone's running the plays at the right time. And the ongoing management, whereas the legal team is one time set up, and then the legal audit defense if there's an audit.
Love it. Well, Brett, great to connect. And for the listeners at home, definitely want to connect with Brett Swarts at capitalgainstaxsolutions.com. The link will be in the show notes, and go get a copy of his latest book available on Amazon. That will also be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.